whether you're a real estate agent or you are a home buyer, what does that journey look like for a home buyer? There's a lot of traditional financing that's available out there to buyers, but those require down payment. They require 2 years income. They require, give me 1 second. I'm sorry. There we go. Problem with my audio. There we go. Okay, they require assets to be verified. They require you to be on the job for 2 years, right? Certain types of ways to calculate income. So this right here is a non-traditional financing. It's the link for homeowners to be able to qualify. Whether you are a real estate agent or you are a home buyer that has been denied for a traditional loan for one reason or another, this could be the possible solution. And it is very, very easy to qualify for this loan. There's a couple caveats in which you do have to meet that requirement, but whether it's 3 months from now, 6 months from now, or a year from now, what does that look like for your situation? And so I typically don't go through guidelines when I am qualifying a client, but as a home buyer and as a real estate agent, I think it's important to kind of step back sometimes and not just talk about, oh, we have this down payment assistance program. There's intricate details when it comes to financing for a home loan that we have to look at: credit, income, assets, trade lines, right? And typically there's a system that we run our traditional mortgages through that tell us if you are qualified for a mortgage or not. And that's called DU or LP. And we do that for FHA, VA, conventional financing. USDA financing has their own GUS underwriting system, but there's a system that collaterally underwrites your file based off the information we put up and it calculates the risk and it'll shoot out your approval. This program is going to be different because it is a different type of financing. So we're going to dive into it and I'm going to explain it to you guys. If you weren't able to join, that's okay. If you were able to join, that's awesome. We're going to send this recording out too, because if it's not you, maybe you know someone who is I-10 and don't have 20% or 10% to put down on a loan. They might fall into something like this, a category for this loan. So we are going to dive into the first slide. Let me get there. 1 second. What is a link loan? So this loan provides a borrower that is ineligible for a standard agency mortgage the opportunity to home ownership. The borrower qualifies for a 40-year seller financing agreement endorsed by a company called Trio. And they get to select their desired home. The client does. Typically, an escrow is, a home loan is a 30-year traditional mortgage or a 15 traditional mortgage. This mortgage is a 40-year mortgage, seller financed. Okay, and we're going to get more into that in a little bit. Upon signing a contract for the deed, the borrower acquires equitable title interest. So our client will have interest in the title to this property. Notably, this arrangement does not involve borrowing funds by our customer. So our client gets to go and have the luxury of shopping for a home, placing an offer on the property, but our borrower is not financing that property per se. We're doing seller financing and Trio is going to be financing that. And we'll talk about that in just a little bit. Subsequently, the seller finance agreement is enacted with an FHA purchase loan with a government entity acting as the borrower, and that is Trio. And they're going to be the owner of the property being financed. So what does that look like? Let's back it up. That looks like our borrower gets to go shop for a home. They find a home, they place an offer. The government entity then has an agreement that they're going to sign, and they're going to have financing, FHA financing on that property. Okay, and we're going to talk a little bit about that in the next slides. Who is this for? Well, why would anybody want to do a program like this? It's because they don't qualify for traditional mortgages. It might be a first-time home buyer. Although there's an amazing first-time home buyer programs out there. I am a first-time home buyer specialist. I always try to push that, but prices are high right now, and we're running into situations where this loan might be a better option for those specific situations, which we will talk about. It's going to be somebody that's self-employed, a 1099 or a gig worker, somebody that's relocating, somebody who has just started a new job, somebody in a wholesale division environment, student loan burdened. That one is huge. College graduates, I-10 DACA clients, somebody that might have some credit issues that are preventing them from getting a traditional mortgage. Next slide. Okay. So what does this loan look like? Well, it is an FHA loan. Any loan program that you do, unless you put 10% down, an FHA loan has your taxes, your insurance, and your mortgage insurance included in your payment. Okay. So say on on a purchase price of $309,000, 3.5% down is the down payment requirement. So $10,815. That gives you a loan balance and a base loan amount of $298,185. So say, and interest rates vary, they're going to be dependent upon several factors. But say the interest rate is at 7.875. On a 40-year term, your principal and interest payment would be $2,041.25. There is a link service fee that you pay. That is additional on top of your taxes, your insurance, and the mortgage insurance premium. And so your total monthly payment on $309,000 would be $2,552. That link service fee that you're paying is also an insurance, and that's going to pay 50% of the payment if you lose your job. So it is an actual insurance coverage on your payment should anything happen to your job, which is outstanding, absolutely amazing. Next slide. Underwriting. Okay, so how this loan works is our government entity, TRIO, is already underwritten, approved for these loan programs. Okay, so TRIO completes that underwriting. TRIO underwrites all of the borrower documentation, their documentation. They issue a clear to close, and we're able to do actual seller financing. So the FHA purchase loan is actually completed by the investor. That investor is only underwriting the purchase loan, and they're looking only at the property, which we'll talk about. We're doing a collateral package underwrite only, and we're going to go over some of those guidelines on what's included on that so that you as the buyer coming in, or if your client as the buyer coming in, make sure that we qualify for this program. Next. Sorry, guys, a little slow here. Okay. So what are credit score requirements? Typically, on an FHA loan for our borrower, there's no minimum credit scores as long as you're DU approved, right? This program does have credit score requirements, so we're looking at everything manually. We have these guidelines, we have to make sure you fit within them. So those credit scores are going to be, they vary based on the type of income you receive. For a wage earner, a W-2 wage earner, the minimum Equifax score is a 600. Now, I said Equifax score. Typically for a traditional mortgage, we pull a full-blown credit report, and we use the middle of all three scores to underwrite your file. That's how the risk assessment goes, okay? We are only pulling a soft inquiry, not a hard inquiry, through Equifax, and your minimum credit score through Equifax only has to be a 600. What does that also mean for credit? That means only credit that is reported on your Equifax score is going to be utilized for our debt to income ratio requirements. Okay, and we're going to talk a little bit more about credit in the next couple of slides as well. So what if you don't have a credit score? And what if you're an I-10 borrower? Okay, because this loan is perfect for I-10. If you do not have a social and you're here working and you have an I-10 number, you're eligible without a credit score. Now, I am well aware that many of my I-10 clients work under a social security number that might not be theirs. And that is okay. We do not care. We're not going to ask any questions about that social security number. We don't even get a verification of employment on this loan program, which is amazing. But we do have to run credit under an I-10 number. And that I-10 number, some of them, sometimes people will run credit and they'll have credit reported. Most of the time they're at a 0 score, and that's okay. That means there's certain requirements that have to be met for non-traditional trade lines, and we'll go over what that means. If you're self-employed, you must have a minimum Equifax score of 660. We do have a program that will allow for lower. They'll allow for a 580 credit score. If you're a wage earner, it will also allow for a 640 credit score, but that is a lease program. And I'll talk just a little bit on that in a little bit here. I-10 borrowers are considered as long as they don't have a credit score on this program. Self-employed individuals seeking a convertible lease can have a score of 640. So that other program that I'm talking to you about is called a convertible lease option. And pretty much what it means is the client will come in and they're qualified the same exact way, except for they have lower standards for credit score requirements and also the verification of rent requirements. But they're going to lease the property for a total of 18 months, and then it's going to roll over and convert to this link loan that we're talking about now. So customers who own a home and they're thinking of retaining the property, they need to have a 660 score. And we can utilize rents for our client to move and qualify for another home. Home prices that exceed 750,000, they're going to require a higher credit score, 700 or above. Next. Okay, so we have to get intricate when we're looking at credit. You can't just have that credit score and automatically you qualify. You have to meet the trade line requirements and the credit requirements. So we have to look in detail at that when we do pull your Equifax score, right? So trade line requirements. There must be verification of an active trade line that has been open for at least 12 months. So you need to have something active on your credit report for at least 12 months. The last payment has to have been made within 90 days of the time we pull that credit report. We can use one current utility bill that has had on-time payments for at least 12 months. And the types of bills that are accepted when I say utility are utility. So they're going to be, you can use auto insurance, internet, cell phone, and other various bills like water bills that have to do with utility. Verification can be done through bank statements. So we can get 12 months bank statements. We can do something called a credit supplement where you get us a copy of the bill and we call and we verify, hey, so-and-so has Mark had on-time payments for the last 12 months, and they'll tell us yes or no, and we'll just mark it off. Or we can do payment ledgers if you're have that information from the utility company as well. Credit requirements. To be eligible, no bankruptcy, foreclosure, or short sale instances. However, these are allowed under certain conditions. As long as they're discharged or the satisfaction of required, and the events must have been documented on the credit report. So does that mean you can't ever have had a bankruptcy? No. That means you can, it just needs to be discharged. Now, this is not a traditional loan. So where traditional loans might require 2 to 4 years of waiting from the actual discharge date. This one does not. It just has to be discharged. So it could be discharged yesterday and you apply for the loan today and we're golden. You would qualify to meet the credit requirements. Tax liens, judgments, those are permitted with the following requirements. Eligible if settled or discharged. So you've had to have either paid it or it needs to show discharged on your credit report. We can use the payment terms. If you are making payments, we can use the payments that are documented in whatever agreement you have. This is big. Student loans must be in good standing, and we use the actual payments as stated on the credit report. Why is that a big deal? Well, because traditional guidelines either require you to use half or a full percent of whatever that balance is, or whatever you can document the payment will be. If it shows zero payment, it's in deferment, we're going to qualify our client for zero payment utilizing this program. You can have $300,000 in student loan debt. And that's big for me because I see it. I work a lot with state employees and teachers who have astronomical amounts of student loan debt. And even though they're deferred, we can't qualify them because their debt to income ratios are too high with the higher the interest rates, and the home prices have increased so much in California. Okay, so what do the debt obligations look like? So I have a little box here. You guys could probably hardly see it because I can hardly see it. But standard credit, we have to include the minimum payment that's listed on the credit report, trade lines, one active and current trade line within the last 12 months, which we just went over. Student loans, if the payment's listed on the credit, we can include that. If it's deferred, it's not included. We don't care. Yes. Collections and judgments, we include it in the payment. If it's listed, tax liens must be in a payment plan, and we need to include that information into the payment plan. And that's big for like a lot of people that owe taxes that are self-employed, right? Charge-offs or medicals, not included. We don't care if they're charged off. We don't care if it's a medical collection. We do not care. Delinquency, no unpaid collections. They can be delinquent accounts, but if they are not in that charge-off or medical standard, we cannot do the loan. We can do the lease program. We can do the lease program for if not to exceed $1,000. So 2 collections at $500. However, if there's collections reported and we pay those collections and I show proof that they've been paid before submitting the file to underwriting, they don't care. So, and that money can come from anywhere. So you can pay collections off before going into underwriting for this. And I will get to the questions just as soon as I'm done here. Okay, what's my next one? Income qualifications. This is huge. Okay. Before this program, I hate denying loans, right? I always have a solution for everyone. I want everyone to be a homeowner. There's just so much benefit in it. But there are circumstances that are just beyond our control. For instance, a client might have 2 jobs that they're working, and they haven't worked 2 jobs for a 2-year history, right? You have to have a 2-year history of working 2 jobs in order to use both of those incomes for qualifying. On this program, we don't care. We don't care. So for a wage earner, income calculations do not follow agency guidelines. How we calculate income for this particular program is we use the year-to-date gross income, all of it, and we divide it by the months and days, and that equals the qualifying income for our borrower that we're using. There's no seasoning requirement for overtime. Typically, it's 2 years traditional. None of that. For overtime, commissions, bonuses, we don't care. Whatever that year-to-date gross is divided by the days and the months that they've been on that job, that's the income that we're using. No seasoning requirement for part-time employment. We don't care. I don't care if they started a month ago, that part-time employment, we can still utilize it. We must document, however, 60 days of income. So we do have to have 60 days of income, and the only way that we document that we'll go over is next. So we document through last year W-2. We collect a last year W-2, but we do not utilize any of that income for qualifying. We just get 60 days of pay stubs. We get 60 days of bank statements showing that net income is being deposited into the bank account. And we don't even get a VOE, a verification of employment. That's what a VOE is. We don't require that. Now, because this is not a traditional loan, we do not underwrite, and it's actually not a loan, right? For our client that's qualifying, you just have to meet these standard qualifications and the loan is yours. That's how it works. So we have to look at your total debt to income ratio manually. So when I get your pay stubs and I calculate your income, your housing payment cannot be over 42% of your total income. Your total debt ratio, so housing payment plus whatever's listed on that Equifax credit report, cannot be over 55. So 42, 55, you're golden. Okay. Huge for qualifying. Next. Okay. Self-employed's a little bit different. The qualifying income is calculated using the lesser of a year-to-date profit and loss, net income average, or 90 days of business bank statements with the gross deposits average. So 3 months of bank statements, whatever is deposited within those 3 months, we get a copy of the year-to-date profit and loss. Whatever is less between those two is what income we're going to utilize for qualifying for self-employed. Less than 1 year self-employed is allowed. So typically, we want 1 year tax returns if they've been self-employed for 5 years. We want 2 years tax returns to do an average for traditional mortgages. You don't have to be self-employed for 2 years to do this program. You can be self-employed for less than a year. Like I said, the only thing that's needed is a year-to-date profit and loss and 3 months bank statement. So if you started your business 3 months ago and we get a profit and loss from, say, January to current, or we get 3 months bank statements, whatever is less on that, we're going to be able to use as income for qualifying for this loan program. For self-employed, the housing payment does have to be less. And that's because your income varies so much. There's a more risk for a self-employed borrower. So your housing payment can't be over 38% of the total debts, and then 55 total back-end ratio. So documentation that's going to be required: last year tax return. If you don't have a tax return, that's okay, because this does allow for you to be in there less than 1 year, but they do like to have 1 year tax return. Now, that tax return might not be for self-employed. You might have went from W-2 wage earner and decided to become self-employed, right? That's the reason why we're needing it. They do like to show that you do have a history of working somehow. Last year and year-to-date profit and loss, we don't really, we're not going to go off that income, but they do like to have that documentation in the file. 90 days of business bank statements, we're going to go off of that. Your profit and loss must be provided by a professional or from bookkeeping. Okay. All right. Next. Cash to close, all the assets. So typically on a traditional loan, anything that is a large deposit has to be sourced, has to be seasoned, right? For a 2-month period, if it's over a certain threshold of what you deposit into your bank account, depending upon the program that you do. So for cash to close on this program, much different. Our customer must be able to document all the cash to close for the program period. The customer funds that are going to be required are the link loan closing cost, going to be the 3.5% down payment requirement, and it's going to be the FHA closing cost. So you have to remember, on this program, there's 2 transactions that are happening. There's a purchase happening from Trio, and our client also has closing costs that they're going to have to pay for doing the loan. And we'll go over what that looks like. Asset docs that are needed. Your assets must be in your account at the time of review. So if you got $50,000 hiding under your mattress at home, I don't care. Put it in the bank. We don't care about large deposits on this program. We're not going to ask about it. But your funds do have to be in the bank account. There's no seasoning of deposits required for this program. And gift funds, those are allowed. So you can go through the traditional way of doing it. We're not going to follow agency guidelines, but your gift funds, they can be from anyone. They could be from a friend, aunt, uncle, cousin. We don't care who they're from. There will be a gift letter that they will have to show that they're not repaying that. And we have to document the gift funds. So you can go that route, or you just get the money and you can put it in your bank account. No questions asked, because we don't source deposits. So you could go either way on this program, right? Okay, next. Fees. So FHA loan is a HUD loan, and they're going to have their standard fees, right? To do an FHA loan, you put 3.5% down. That's the minimum down payment requirement. They have a 1.75% funding fee that's financed into the loan. And they have the other closing costs that are associated with a purchase transaction. So those are going to be your title and escrow fees. Those are going to be your third party fees, right? Appraisal, that sort of thing. Your link loan, in order for our borrower to do this program with all these fun little scenarios that we got going on here, we charge a 0.75% of the purchase price as an origination fee. The closing cost to do this loan is $1,295. The signing fee, $465. And if there's an HOA servicing fee that we service, then that's $325. If you get a home warranty, or you can get a home warranty, it's not required. There is a payment protection plan. That is something we go over much later in the transaction. But what that is something that is required to the loan. So that service fee that I was telling you that you pay as part of the fee, that is part of your payment protection plan. So if you lost your job or something happened and you needed some of your income covered, then or some of your payment covered, it's going to cover 50% of your payment for you. You do have a homeownership counseling that you'd have to take, and we have the information that we refer out to for you to utilize that specific homeownership counseling. And they do require you to have a renter's insurance. So that's included in your when you get into escrow. We will shop around and we will get your homeowner's insurance. On top of that, you're also going to have renter's insurance, because technically you don't have ownership in the property. So it's a renter's insurance, homeowner's insurance combination package that you have to have. All right, next. Housing history. So your down payment amount is going to depend on housing history. And this is where structure comes in. You must have a minimum of 12 months of rental history. So we can use a verification of rents or a credit supplement. Plus, we need to have 3 months of verifiable payments that are accepted under the following conditions. If you want to only come in with 3.5% down on this program, you have to have all 12 months verifiable with proof of payment. Now, proof of payment cannot be receipts. It would have to be Zelle. What else? Bank statements, right? Showing the amounts coming out of your bank account, canceled checks. It could be Venmo. It could be a ledger from from the rental department, right? But they don't want just a VOR, a verification of rent. They want to show proof that you have been the one making these payments. This is big because a lot of people live with family, right? So there's structure that we have to do. Now, 5% down will be required if you have a 700 plus credit score, if you have 3 months only verifiable rent. So if you come to me and say, hey, Marissa, I don't have any verifiable rent. Now I can get a verification of rent showing that I've made 12 months of payments on time, but I can't provide 3 months of bank statements or cancel checks or Venmo receipts. Then I'll say, okay, if you have a 700 credit score and above, and we wait 3 months and we can verify 3 months payments, it's only 5% down. If you have a 699 or less credit score, they're going to require you to put 10% down. So rental history is what determines how much money you have down and verifiable rental history. Okay, here's the good news. Say you're a son and you live with your parents and it's your parents on the lease or your sister on the lease, somebody else on the lease, and they are making rental payments. They can actually co-sign for you on this program and this satisfactory would be done. So they do allow for non-occupying co-signers on this program taken into consideration, and you would be allowed to put your 3.5% down. So that is a caveat of this program as well, is they do allow for that. But we still have to show and work on that housing history and what that rental history looks like. Now, I didn't talk about this and I didn't put it in the slides, but the lease option program that I was talking about earlier and the 18 months of payments that we have to show, that particular program doesn't require 12 months. It only requires 6 months. And there's really no difference in the two other than it is a lease option to buy from the seller. So they're going to lease for 18 months and then things change. Then they go on to the contract for deed. We start that process then. Okay, next. So what does that housing history look like? For 12 months, that payment history needs to be on time and in good standing. So no history of late payments, collections, or other rental violations within the most recent 12 months. No evictions in the most recent 24 months. No unresolved housing or utility collections allowed on the credit report. They're allowed, but they have to be paid. Housing payment needs to be documented, changing hands, transferring to another party. Lot rent. Some people live in mobile homes and they rent, they pay for the lot, right? Space rent is what it's called. You are allowed to have that transaction happen or that use that rental history, but because it's so much less than the standard, they don't require the 3.5% down, they require 5% down. Related party housing history. So if 2 people are listed on the rental verification, related or not, we don't care, both must be on the application unless verifiable that the applicant is the only one making the rent payments. Okay, so if you and your sister are living on in the house together and you're splitting the rent payment, then both of you need to be on this application to move forward as well. Mortgage. You're not renting, you have a mortgage. You need to have on-time payment history for at least 12 months documented on the credit report. Say you don't have any payment history, then you're not eligible for the link loan. But you are eligible for the convertible lease program that I was telling you about earlier. Only 580 credit score minimum and 6 months of payment. So that's fine. That's okay. This is still an option. We can still utilize if any of the circumstances from income, assets, credit fall on our client, that's going to put them, 2 to 3 years out from being able to purchase. This is still an option as long as we start paying rent for a certain amount of time, whether it's 3 months or whether it's 6 months. That just depends on how much money you have too. Remember, gifts and everything are allowed. So it's all about structure and planning your roadmap to home ownership through the program details. All right, what's next? Inspections. So they do require home inspection. It's required on every link transaction. A new construction home inspection is waived. They do require a roof certificate, not a report. They want a certificate. It's only required for homes that are 10 years or older, or when we get the appraisal back, if that condition is a C3 or C4. What a C3 or C4 is, I have that listed here. It's generally a home in good condition. It might need moderate repairs, or if the house is in fair condition and needs significant repairs, they're going to require you to have a roof certification. If it's not, if it's less than 10 years old, they're not going to require a roof certification. A pest inspection is also required. Here's the thing. We don't want the inspection reports. We don't care about them. We just need the invoices to show that they were ordered and that they were done and our client knows. That's it. That's the only requirement. Okay. Okay, purchase contract. Okay, so this is a question that a lot of real estate agents have, right? So if our borrower is not the one who actually is purchasing the home, how does this work? Our customer, Mr. Borrower, is going to go shop for the home with their real estate agent. You're going to find a home, you're going to place an offer, and you're going to write a traditional purchase contract on that home. You're going to give an earnest money deposit to the title company on that home, like any other person purchasing. The seller and the customer must also sign an assignment of the purchase contract over to our government entity. So what's happening is you're purchasing the home, but you're assigning it to the government entity. And we have a copy of the form that both our borrower and the current seller of the home would be signing. The customer is going to sign that TRIO payment disclosure, which will trigger the assignment of the contract to be signed by the government entity, and the correspondent starts the FHA loan. So the FHA loan, so you guys know, with our government entity, that is TRIO, they're already approved for this program. The only thing our investor is looking at when they're underwriting that FHA contract is the appraisal, the condition of the property. The property needs to meet HUD minimum standard requirements. That's all. As long as we meet HUD minimum standard requirements, that FHA loan is for sure going through. And as long as our client meets the TRIO portion and agrees to the terms, then our loan is going through. Okay? Okay, next. An FHA loan, what does that look like? Because many of my clients that signed up for this are home buyers. We follow HUD standards handbook. Okay, so it has to be FHA compliant. No health or safety issues, and anything that is health and safety issues needs to be addressed. The borrower and owner is a HUD compliant government entity. So that is, we're talking about our seller, right? Who the TRIO. The collateral underwrite that is happening for that FHA loan portion, they're only looking at the title work to the property and they're looking at the FHA appraisal. Everything else is done. Standard FHA disclosures delivered to the government entity. Standard FHA closing documents are issued, and no occupant information is included with the FHA loan. So our borrower can purchase this home as a owner occupied, or they can purchase it as a second home. Either way, with the 3.5% down. Okay. That's also big. Ownership. Borrower receives all benefits as if they are the primary owner. You guys, this is a contract for deed. You're not on title right away, but you have a contract for deed. So to gain direct title ownership to the link for our link customer, they must pay off the outstanding balance on the link loan. Just like on a primary loan. Say you purchase and do a traditional traditional loan program. You keep that loan for 30 years. As soon as that loan's paid off, you get the deed to the property, right? Same exact thing happens here. Now, there is a 3-year prepayment penalty, and that amount is 2% of the purchase price of the link loan. So whatever the link loan purchase price is, 2% of that, if you decide to refinance, say in 2 years from now, you qualify for a traditional loan and the interest rates fall, and you want a traditional loan because we can lower your payment. It makes sense, right? Then you're going to have a prepayment penalty that has to be paid, and that is determined. It's 2% of that link loan that has to be paid within a 3-year period from the time that we close escrow. Now, our customer can make 480 payments, 40-year term, and that deed is going to be transferred to you. You can refinance, no prepayment anytime after that 3-year period. And I believe they're talking about changing that 3-year to a 2-year. I heard last week on a call. So if that happens, that'll be better. Refinancing is allowed via the contract for deed, and it may be completed when the customer qualifies for a standard loan within 2 years. Customer retains the remaining equity. This is not a split equity position. We don't care about that at all. That home is yours. The equity in it is yours. If you decide to sell the home after 2 years with written permission from Trio, whatever is there is yours. You get to operate this home as if it is yours, okay? You're gonna get all the interest write-offs, you're gonna get all the tax benefits, everything equity is yours. Next. Okay. That is the main gist of the program. So I know, so if I'm a teacher with 0% payments on your student loans, yes. Yes. Yes, Aaliyah, that is absolutely correct. Let's see if we can pull this up. So I would like the opportunity to be able to answer any questions that anybody might have. So utilize the chat box. If you do have a question, drop it in there. If not, all of my contact information is right here. You're welcome, is right here. You can email me. You can call me anytime. I'm available on weekends. That's fine. But this program, you guys, is a huge game changer to help you be able to get into a home if you're not qualified, right? So, hey, Tamisha.
Hello, Marissa. I just wanted to ask a question. If you can explain more about the government entity part, I'm not really quite understanding it. Thank you.
Yeah, absolutely. So the government entity is the actual seller. That's Trio, right? So our buyer is not necessarily our buyer. Our buyer, say, Tamisha, you refer me a client, right? And I do the loan for the client. Our client is qualifying for the link portion of this loan. Our buyer is not taking out a loan, though. The person taking out the loan is our government entity. And the government entity has been partnered for this transaction for the last 30 years. It just opened up in the state of California, and they're allowing us to do it now. So they've been around for a long, long time, partnered with HUD. HUD is the one partnered with Trio in order to issue the financing, and they're going to be the ones collecting the payment and paying it to the servicer. So they're just really keeping that service link fee, and everything else is going to pay down the balance of their property. They're allowing our client, instead of us doing a traditional 3.5% down loan and just having the standard payment that you have, what they're able to do is recast this loan, right, over 40 years instead of 30 years. So you're able to pay it longer. And that helps people that are, say, I-10, right? That sometimes it'll take 10 years to get a citizenship to be able to own a home. Say it never happens, or honestly, a lot of clients are just too afraid to have something like that happen and reach out to those government, when it comes to the government and they're here. So no matter what, say they never become a citizen and they only stay in I-10, in 40 years, they have ownership to this property. Did that answer your question?
Yes. And so if I was interested in this, I would need to just book like a private consultation with you to
Yes.
go over it further. Okay.
Yes, absolutely. Because everybody's financial situation is completely different, right? And so we want to analyze everything. Um, what I went over is the only thing that's needed, hardly anything to qualify for this loan. So whether you're a home buyer and you're interested in this program and looking at it, or you know somebody, yeah, we will just book a consultation. I have a Calendly link that I will send to you that will have a one-on-one conversation about your financial situation and see what we need to do for the next steps.
And then just one more question. When you
Sure.
were talking about the renters, so like right now, I'm a renter with my partner. We rent,
Mhm.
but my name is on the lease. My partner
Okay.
name is not on the lease. So how would that work if, because we're interested in looking to buy a home?
Yeah.
Would that
So
my partner need to be added to the lease?
no, only one of you needs to be on the lease, not both of you.
Okay. Okay.
Perfect question. Yes.
Thank you.
The big thing is documenting how your rent is paid, right? So
Yeah.
depending on how it's paid, it's going to determine how much money down. Good question.
Okay. Thank you.
Does anyone else have any more questions? Okay, well, if you can think of them, let me know. You have my contact information. Listen, it might not be you. You might be talking to somebody. I'm all about education, right? So if you know somebody and you're talking to them, people think that there are no solutions out there. They'll never be able to own a home. This is a solution for people who have been denied or feel like they could never own a home. So get them in touch with me. Let me talk to them and let's get some more homeowners out there. We live in California, y'all. We need the tax write-offs. You're welcome, Ashley. Okay, everyone, have a blessed weekend. Call me if you need anything. Bye, everyone.